Well, good morning to each of you and welcome. My name is Joe Bloodgood. I'm a partner with Boulay Financial Advisors. We're excited that you could be with us today for about the next 45 minutes or so. My partner Nathan Faith and I are going to be discussing a post-election policy forecast, tax and wealth planning under a new Biden administration. As we get going this morning, I'll share a few housekeeping items before we jump in. First, this will be recorded and you will receive a link as a follow-up to this conversation. Second, I would encourage you to use the Q&A box within Zoom to offer up any questions as you have them. If we don't address them directly during our prepared comments, we'll plan to answer any questions at the end of our time here together. So as we get moving, let's jump into our content this morning. As we do that, I wanted to just share with you, our core values at Boulay are summed up in 8 core values that we call the Boulay 8. And one of those is proactivity. And that's really the theme today. I think you'll find we don't know exactly what the future will look like. We're making some prognostications and some best guesses about what we think may happen. But what we're really trying to do is think proactively, help our clients look around the bend in the road and plan accordingly. The other thing I would offer is just a general disclaimer around politics. Politics, as everyone understands, are viewed differently. We have clients on both sides of the aisle. Please know that when we talk today, we're not taking sides. We're trying to call the issues as we see them and make plans around what we think may happen. So as we jump in today, I think it's helpful to get a sense of what the current lay of the land is as a follow-up to the elections just a couple weeks ago. So barring something unforeseen, I think it's safe to assume that Joe Biden will be the new president of the United States, that the White House will have a new resident come January. Beyond that, if we look at the other houses of Congress, if we look at the House, the Democrats still have control in the House. The Republicans did pick up a number of seats, but as you can see, that's still controlled by a majority of Democrats. And then if we look at the Senate, I think most people understand this, but this is, at this point, unable to be called. So there's currently 50 seats that are held by Republicans, 48 seats that are held by the Democrats, and there are 2 seats that are still up for grabs that are going to be part of a runoff in the state of Georgia right after the first of the year. So it looks likely that the Republicans will hold control. However, if they don't, if they were to lose both seats, the vice president would cast the decisive vote in the Senate. And as you understand there, if it in a 50-50 split, that decisive vote would be cast by Vice President Harris. Important to know here, the next midterm elections that are set for 2022, if we think forward 2 years, what we see there is 20 incumbent Republicans and 12 incumbent Democrats with their seats on the line. So if we fast forward to 2022, you can see there's actually more Republicans with their seat being contended than there will be Democrats if we fast forward just a little bit. So hopefully that provides a little backdrop on where we're at. Let's take a look at just a couple slides that address the markets before we talk a little bit more in depth about what some potential policy changes could look like. The first thing I'll mention here is it can be tenuous to draw hard and fast conclusions around elections and who's in charge and what the market does. So I'll lay that as the backdrop. The first thing I'll mention though on this slide, really what we're doing here is we're looking at elections under a variety of different scenarios, and we're looking at the first 2 years after an election, and then we're looking at a full 4-year term. And you can see the first thing I'll point out on the far right-hand side, the dark blue bar, the what has been historically the highest periods of growth, for whatever reason, have aligned with a Democratic president and a divided Congress, right? And if you had to place a bet on what we were going to have this year following January, that's likely where we will end up landing. The other thing here I'll mention, though, is as you can see, there's a number of different iterations here. The markets tend to work in spite of politics and not because of it. I think what's more relevant will be some of these potential policy changes as we go. But if we look at the next slide, if we look at kind of those different scenarios and we look at the growth in the markets in the 48 months following a new president taking office, you can see there's different rates of return here, but generally speaking, the overall trend is a positive one. After 48 months following a new president, what you see there is, in a worst case scenario, right, your money grew by more than a third. And in a best case scenario, your money grew by nearly half. And so again, I would point back to my comments before about how markets tend to work in spite of politics, and it can be challenging making prognostications based on who's in the White House or who's controlling Congress. But that being said, I think where some of the most interesting potential changes could lie are on the tax front, and then specifically around financial planning and different strategies that might apply here. So I want to bring in my partner Nathan Faith. Nathan's going to speak about potential changes, timing, and then what comes next. Nathan?
Thanks, Joe. So as Joe mentioned, politics over time doesn't have much of an impact on what your money can earn in the markets. But where it can have a big impact is how much you get to keep of what you earn. And so we're going to talk through the when and how politics may impact your tax bill. So kind of going back to the slide that we saw earlier on the political front, there's a few scenarios that could play out and may impact the timing on when big changes can happen. So we know that Joe Biden won the presidency, but it is still up for grabs whether the Democrats would win the Senate and have a majority. They have to win both seats with the Senate runoff here coming in January, where the Republicans only have to win one. So it's a lot easier to flip a quarter tails once versus flip it heads twice. And so the probabilities of this majority going through for this next term are less likely than the alternative. But if it were to happen, the changes that could impact your taxes could occur as early as next year. And so historically, what's happened with presidencies is when they have a majority in Congress, they can make their big changes. So Barack Obama created Obamacare when he had his 2 years of really a blue wave. Donald Trump passed the recent Tax Cut and Jobs Act when he had a red sweep. But if Democrats don't win both seats of the Senate here in January, then we experience what's really a blue ripple, in which Biden is the president. He can make executive decisions that impact where we stand on the global front, but politically it'd be tough to make any monumental changes on the tax front because the Republicans would stand in the way. However, that may be a relatively short period of time. As Joe mentioned in a prior slide, senators are up for re-election every 2 years. 1/3 of the Senate comes through on a kind of conveyor belt approach. And the Republicans are actually at greater risk than the Democrats, in which they essentially have 2 seats at risk for every 1 seat the Democrats have. And the Democrats would only have to win 1, maybe 2 of those 20 seats that the Republicans have at risk. And there again, the Democrats could have the last 2 years of Joe Biden's presidency in a majority, and then affect the items on their agenda for at least the next 2 years. And a less likely scenario is if the Republicans win at least one of the seats in this January runoff for the Senate, but again, hold on to all of their seats and maybe even win a few extra seats in 2022's midterm elections for the Senate. But notice how the year in which big tax law changes isn't indefinite. It's actually the year 2026, and that's a critical component. When Donald Trump was able to pass the Tax Cuts and Jobs Act at the end of 2017, because there are tax cuts and the budget could only go into a deficit for so long, there had to be a self-destruct set up on most of those laws. And that time frame is 8 years. So in the year 2026, most of the major tax law changes that impacted our wallets will actually revert back to the tax code and tax system that was higher rates at lower levels of income in the year 2026. So let's take a look at the advertised, publicized agenda that's on the Democratic wish list. And let's start with the big companies, specifically C corporations. 3 years ago, corporate tax rates were at a top rate of 35%. But with the tax law changes, those rates were reduced to a flat 21%. The proposed change to those tax rates is to increase the corporate tax rate from 21% to 28%. Now, this is somewhere in the middle. And as you'll see later, this is the only Democratic proposal that doesn't at least bring tax rates up to where they were a few years ago. And a reason for that may be that the revenue that the IRS collects is actually collected more so from us as individuals than from the big corporations in our country. And so if there's going to be impactful changes, go to where the source of the money really is. And that brings us to our estates. So estates are our wealth, and they can be taxed. Now, wealth taxes are quite rare. We as financial planners and accountants can do a lot of things to manage your income that comes from your wealth so you pay less in taxes. But avoiding taxes on your wealth can be more difficult because your wealth tends to grow over time. An example of a wealth tax that you all likely experience is your property taxes. Your home each year is revalued. If it goes up in value, your property taxes are pegged to the value of your home and you pay more. And it's very difficult to try to convince the government that your home is worth less than it is. And so that's a major target on the Democratic wish list. The first big change, which is a new change, would be an approach to eliminate the step up in basis on gains upon our death. What does that mean? If you bought any investment, any property, and it's now worth more than what you paid for it, you have a gain. And if you sell it during your lifetime, you then pay a tax, an income tax. The top tax rates right now as Minnesota residents is you pay about 1/3 of that gain in income taxes. However, if you pass away and transfer your property onto your heirs, the value of your investment gets stepped up to the value of the investment on the day that you passed away, meaning the gain goes away and your heirs don't have to pay that tax looking in the rearview mirror. The Democratic proposal is to eliminate that and have your heirs receive a Passover basis, meaning they'll pay that gain alongside with ultimately maybe even paying an estate tax. So know that that tax law change was actually in existence about 50 years ago or so and didn't go over well because at the time we didn't have the regulations and technology to track what we paid for investments way back then. But now we do. And so with the trillions of dollars of assets that we all hold collectively and the big wealth transfer that's set to occur over the next generation, this could be a huge revenue raiser for the government. And then on the wealth tax front with estate taxes, what are those really? Estate taxes are those in which your wealth is taxed above and beyond a certain threshold. And that threshold is called your estate exemption. It's really a deduction. how much wealth can you pass on to your friends and family without paying additional taxes. The exemption was increased with the tax law changes by Donald Trump from 5.5 million to about 11 million 3 years ago. The Democrats are proposing to reduce that exemption back down to where it was at the 5.5 million. That's a little early, but it was going to come anyway again in the year 2026 when estate tax laws sunset under the Tax Cut and Jobs Act. Now, most of you are here because you're most interested in how you're taxed as individuals. So I'll give you a moment to read the bullet points here. But instead of trying to form a mental picture, we'll actually walk through an illustration on how the tax laws change for you individually. And so we'll talk through first the most common tax that you pay, which is one on your ordinary income. And this illustration here is one that shows a side-by-side comparison of the tax landscape under the current system, which is on the left, and the proposed revisions to the tax code under the Biden agenda on the right. If we look at where we're taxed on much of our income, which is called ordinary income, this is that first column on the far left. What is ordinary income? That's our salaries, our pension income, Social Security checks, IRA distributions, and any interest that we earn through the bank or on bonds. It's a lot of our income. And under Donald Trump's changes to the tax code, the top tax rate was reduced from just under 40% to 37%. Under the proposed Biden agenda, the top tax rate would be increased to where it was at 39.6% just a few years ago. However, the sneaky change is that it wouldn't be a lateral move in which we simply replace the top tax bracket with a higher rate. It's actually a migration south in which at lower levels of income, the top tax rate is achieved. And specifically that line in the sand, if you don't take away more than one thing from this presentation, remember this number, $400,000. That's the line that the Democratic agenda references over and over and over again regarding when these tax law changes would impact our planning. Why $400,000? That's seen as being where the top 1% of wage earners lie, and the political process has been targeting the top 1%. And so that's the first change. Then let's move over to where our smaller businesses get taxed. We talked about the big corporations, but what about our S-corporate business owners or our partnerships or LLCs or self-employed folks? Under the current system, they're taxed under this second column, in which below about $320,000 of income, everyone receives a 20% deduction on their business income, meaning 20% of their income is tax-free. And above that line, if you're in a service business like Joe and I are in, where we give our advice based off of our minds, we can be phased out of those tax benefits. But if you're in a business that makes things, you actually receive that 20% deduction on an infinite level of income. The Democratic proposal is to phase that out for all small businesses, where again, once one's income rises above $400,000, you're now at top ordinary tax rates. So next, highly publicized change that we're watching has to do with how our portfolio income is taxed, specifically how our income is taxed that comes from stocks. So we can make money in two ways. We can either earn dividends from stocks, or we can sell them for a profit, a gain. And they're actually taxed exactly the same. In this third column under the current system, the top tax bracket is 20%. That was actually increased by Barack Obama when Obamacare came through, from 15% to 20%. But the proposed Democratic change is to double that top tax bracket once a married couple or a single individual have $1 million of income coming from a portfolio. Now that's the first time that ordinary income and qualified income, being long-term dividends and capital gains, could be potentially taxed at the exact same rate, at least during our lifetimes. So now we'll go back to our list here and talk through how the proposed agenda may impact our deductions. How can we manage our income lower, and what type of return do we get for those decisions? And so we're going to talk through impacts that could happen our itemized deductions as well as our retirement plan contributions. So regarding itemized deductions, what are those? Those are your contributions that you make to charity. Those are deductions that you have for paying your state and local income taxes, interest on your mortgage, and medical expenses, itemized deductions. The Democratic proposal is to limit the value of those deductions as your income rises, specifically above this line. Once you exceed this line, the deduction, instead of being worth whatever your tax bracket is worth, say 32, 40%, it'd actually be locked in, fixed at no higher than 28%. Now, that isn't a completely brand new change. Under the old law, our itemized deductions would get phased out over time as we had higher income, but it would still cut the value of our itemized deductions down by up to a fourth. And with that same line in the sand, there's a proposal regarding impacting our retirement savings. So typically, whatever tax bracket you're in, whether it's red or green, your contributions to your 401ks, IRAs, receive a match, a contribution, a tax savings from Uncle Sam at whatever your rate is. The proposed agenda locks that match in, regardless of your tax rate, and even 26%. Meaning, if you're at top tax brackets and you'd normally receive a 39.6% deduction, you'd receive a 26% tax credit. So if you contribute $10,000 to a 401k, you'd get $2,600 back as a tax refund. But the same can be said for those who are at much lower levels of income, in which if someone who's at the lowest tax bracket contributes $10,000 to their 401k, they too get a $2,600 tax refund. Now, that provides a little sneak peek into some of the strategy shifts that may come about with these potential tax law changes. Anyone below this line would actually choose to make pre-tax 401k contributions because they can receive a tax credit at a higher rate than what they're in. And if they wanted to, they could immediately convert or move those dollars to a Roth account, a tax-free account, and pay less in taxes than what they received initially, and vice versa for anyone above that line. You don't want to receive a tax benefit at 26% if when you withdraw the money from your retirement account, it's taxed at 40%. So anyone above the line would likely choose Roth contributions. So now let's talk through a few other potential changes that have to do with payroll taxes as well as benefits for our children. So payroll taxes, what are those? Under our current system, we have to pay in to Social Security and Medicare each year until our income reaches about $140,000 a year. We pay in about 6% to Social Security, which is about $9,000 a year until it's maxed out. And we pay about 1.5% to 2.5% into Medicare as our income rises, which never actually ends. If you're self-employed, you can double those tax rates on the way up. However, under the Democratic proposal, they create what's called a donut hole, in which we would have the same first limit on our payroll taxes up to about $140,000 of income. You get a breather until, again, that $400,000 mark, that line in the sand. And then those payroll taxes would fire up all over again indefinitely. And so that's a major, major change, especially for our friends who are self-employed folks, because they would have an additional 12.5% tax on all of their income above and beyond that line. So moving on down the list, another big change has to do with the child tax credit. So a few years ago, the child tax credit was $1,000 per child under the age of 18. And that was actually increased to $2,000 per child under the age of 18. The Democratic proposal is to increase that child tax credit to $3,000 per child. But again, that phase out line that we've been talking about, that occurs at $400,000. And that tax credit is phased out quite quickly over the next $40,000 or so. So that's a view of the changes to the tax landscape. And now Joe and I will talk together through how our planning and strategies may evolve.
Yeah, thank you, Nathan. That's a great summary of some of the potential changes that we could be looking at. And I come back to the idea that with change comes opportunity. And like we've talked about, really the idea here is to make sure that we're being proactive and looking at strategies that could potentially address different circumstances. And I wanted to just go through a few of those circumstances with you, Nate, and maybe we'll even use kind of this line on the tax heat map as kind of our reference point as we talk through some of these scenarios, but maybe just a simple one to start. I think there's enough jargon and discussion, and sometimes I think people hear this terminology around, manage your tax brackets and, make sure you're in the right spot. But I don't think sometimes we know exactly what that means in actual practice. Maybe let's talk about an example where we're able to be proactive with tax bracket management and how that might look.
Sure. Yeah, thanks, Joe. Tax bracket management is exactly what it looks like when we line up all the various taxes next to each other. With planning, what we do is we look at not only where tax rates are today, we forecast them into the future, and then apply them to your personal financial situation, because your income ebbs and flows too over the course of your financial life. As you have your high income earning years into retirement, and then as you turn on your retirement and Social Security benefits. What we found is a very common line in the sand is when the green starts to turn into the red. So we've been drawing a line in the sand for our clients for the last 4 or 5 years at about this level, and that might shift up a touch to this $400,000 level in future years. But really what it does is identifies what we call a Goldilocks line, where the taxes we pay aren't too hot, the taxes we pay aren't too cold, they're just right. And from there, we can then decide what decisions we should make. If we're above the line, how to bring our income to the line. If we're below the line, how do we bring our income up to the line? And that's where some of these powerful strategies can really come to roost that Joe and I will talk through.
Thanks, Nathan. Let's say, we work with a lot of clients that are in their peak earning years, right? A lot of owners of closely held businesses or high net worth individuals or professionals that maybe have a shorter runway before retirement. And right now they find themselves north of that line, right? Wherever we draw that line, they find themselves beyond that. What are some strategies we can do to tip over the scales and bring them back under that line?
Yeah, I'll show you an interesting one that's probably the most powerful financial planning strategy that we've seen that could become more powerful if tax rates go up. And that has to do with charitable planning. So imagine your income, at least for a given year, is right here at the top. You're at top rates across the board. And imagine that you're looking to do something with $100,000. You could either give it to charity or you could keep it. If you were to give it to charity, you receive a tax deduction. And you first receive it at this first column, ordinary income. So that'd be a 40% tax deduction if tax deductions aren't reduced by that amount that we talked to before of 28%. But let's assume it's 40%. So that's a $40,000 tax savings on a $100,000 contribution. But again, you get to save an additional $10,000 in Minnesota taxes because charitable contributions also reduce your Minnesota tax bill. And so you've so far saved $50,000 by gifting cash to charity. Now we'll layer on a slight twist to the story. Instead of giving cash, what if you gave highly appreciated investments, such as a stock? If you bought Amazon or Apple stock anytime over the last 10, 20 years or so, what you invested is hardly anything compared to what it's worth. And if you instead give that stock directly to charity, charities are tax exempt. They don't pay that tax that you would have had to pay if you had sold the investment yourself in order to raise the cash to give to charity. And so you actually save taxes again here at the very tip top of this qualified income bucket at 40%. So we're now at $90,000 of tax savings. You again avoid an additional $10,000 of taxes with Minnesota. So we're at $100,000 of tax savings. And you also avoid an Obamacare tax called the net investment income tax, which is about 4%. So your tax savings amounts to $104,000 for a $100,000 charitable gift, where even those who don't have a charitable bone in their body, like Uncle Scrooge, would be willing to give money to charity because they actually come out wealthier at the end of the day. Now, even if itemized deductions are limited, that charitable benefit would still be in the 90th percentile, meaning you contribute $1 and Uncle Sam's really contributing $20 for your charitable planning and endeavors.
That's a really cool strategy. I think that's a pretty unique opportunity for a lot of folks. You know, so we talked a lot. We talked there, Nathan, about our clients that find themselves above that line. You know, we also have a number of clients, and the common scenario is they've worked for a number of years. They were successful at whatever they did. They've accumulated enough wealth to maybe retire a little bit early, and they find themselves in a spot where they have a gap between their highest income earning years and the time at which maybe things like Social Security and required minimum distributions kick on. And so they're in this weird spot where they're well below the line for the time being, but we don't have to look out very far, and we see that they're going to be forced back above that line. Let's talk a little bit about maybe how we smooth out that ride. Can we actually pull some income closer to today, pay some tax now, and maybe smooth out that ride later on?
Yeah, moderation is the key when it comes to planning. And to give you some insight, the tax law changes that were passed 3 years ago, that green area was pulled up $250,000 from $80,000 for a married couple to about $350,000. That's set to last for another 5 years or so. And so far, the Biden agenda is only pulling higher tax rates up above that line, not really impacting the tax rates below that line. So we see this as a once in a generation, maybe a once in a lifetime planning opportunity where you can deliberately pay taxes early so that you don't have to pay them again. And two examples of that are, you can actually fill up this first column with income that you haven't paid taxes on yet from your retirement accounts. 401ks, and IRAs. And you can place those in a forever tax-free account called a Roth IRA and deliberately pay the taxes early. Many of our clients are converting $100,000, $200,000, $300,000 of their IRAs to Roths each year. And if you do that for 4, 5, 6 years, you have millions of dollars in tax-free accounts that never get taxed again. Another strategy is to harvest gains. When you're in these cooler tax brackets, before you flip over into a hotter tax bracket, deliberately harvest gains within your portfolio. Now, you don't have to be out of the market or out of the investment for very long, because with gains, you can literally sell your investment and buy it back minutes later and pay the tax on that gain while the getting's good, so that you don't have to pay the taxes down the road when tax rates may be higher.
Great, thank you, Nathan. Just a couple more, and then we'll have a few minutes for questions and answers. The other scenario we see frequently is, let's say, yes, you have retirement accounts, but you also have a lot of your wealth in a taxable situation, right? And so the most common scenario we see there is somebody has a lot of money in a revocable trust or a brokerage account. And I think sometimes the feeling is, well, what can I do to shelter some of this income coming off my investments? What are some things that we're thinking about on that front?
Yeah, so I'll tell an example, tell a story. Imagine you're a successful business owner and you sell your pride and joy for $50 million and invest your money in a diversified portfolio. And from that portfolio, you receive $2,000 a year in dividends and portfolio income. Now that puts you well above this line. But what can be done is you could take half that portfolio and leave it as is, and have that income recognized at these cooler, lower rates before you flip over into this dark red area where the tax rate doubles. Migrate wealth into a tax sheltered account. Now, many of us think, well, I can only have so much money in a retirement account, like a 401k and an IRA, because I'm limited to how much I can put into those accounts each year. And that's true. But there are non-qualified retirement accounts that don't provide you a tax deduction going in, like a 401k does. However, they provide the benefits of tax sheltering and protection going forward. So a tool that we use and we expect will be used much more going forward is one that's called an investment-only variable annuity. So it's not an annuity as many folks would think of it. It's really a retirement account that shelters income. And considering stocks and bonds going forward may be taxed at the same rate, and there may not be a step up in basis provision going forward on gains upon our death, those tools could be the perfect way to time when and how you distribute your income and stretch out your distributions over many, many decades.
Very good. So maybe to put a bow on it, Nate, anything else on the planning horizon that you think might become a little bit more mainstream or popular if we do see some of these changes come to fruition?
Yeah, so a few things. It'll be more on the planning and creative front to work under these lines in the sand. And so one example is, how will businesses or investors sell their investments going forward? Well, that's where you'll just have to negotiate and be more creative. An example would be, imagine we're under this tax system on the right, and you have a business worth $2 million, and you're looking to sell it in December. Instead of selling it for $2 million in December, you could set up an installment sale, break it up into two parts, in which you sell half, $1 million in December, and pay taxes at these lower rates. And then you sell the other half a week later in January and pay taxes at these lower rates the next year, versus having that other half be taxed at twice the rate. Other considerations: if there are ways to reduce your gain and push out that tax bill, those tools will become more favorable. An example are opportunity zones, which are investments in communities that tend to need a little boost. Another strategy that may come to fruition has to do with how we even file our returns. Right now, under the proposed agenda, there is no way to differentiate single individuals from married individuals, couples. This line in the sand of $400,000 of income before top rates on ordinary income and $1 million of portfolio income, then taxed at top rates, that's applied to both single and married couples together. So a strategy could be, why not just file their tax returns separately so that you have a married couple with 2 times the capacity to harvest gains or 2 times the capacity to recognize income. And that's something that's totally legitimate and legal. It's a loophole that could potentially be closed. But there have been marriage penalties in existence for a long, long time. And it looks like those may potentially actually be increased.
Great, good stuff. Let's wrap up our time with some Q&A, and I would just remind everyone, if you have a question, feel free to use the Q&A box, and we'll go through some of these and hopefully address many of your questions that are on your mind. Nate, one question we received was that, would it be fair to say if the Republicans stay in control of the Senate, the Biden tax proposal is it dead on arrival? Is it a sure thing that it wouldn't take effect?
Yes and no. The Republicans aren't naive. They know that they have a lot of risk 2 years from now. And knowing that they have that risk, they might be in a position to negotiate. And so maybe these more extreme agenda items won't come to fruition, but something somewhere in the middle.
Great. Maybe we could go back to that tax heat map. We had a kind of a specific detailed question in the qualified business income column around $400,000. There was a little sliver that showed 52%. We had a question around that. Could you speak to why that is?
Yeah, it's a great observation by a very eagle-eyed client. That's the most painful part of our existing tax code, and why that exists for businesses that are service-oriented. So you think of doctors, attorneys, financial advisors, accountants. We get phased out of tax deduction as our income rises above this line. And as our deduction gets phased out, as our income tax rate increases, we run into this negative feedback loop in which our cost per dollar of additional income skyrockets. And it's in this area, which is $100,000 wide for a married couple, one's tax rate can essentially triple from being under 20% below that line to almost as high as 60% in that phase out range.
Yes, good stuff. We did have a question around just a reminder of one of the tax sheltered instruments we mentioned. I can address that. There's a number of different strategies that can work there. I think a lot of times what we'll talk about is something called an investment only variable annuity. Really different than any sort of traditional annuity you might be familiar with. It's really primarily functions as a tax deferral strategy. So that was the answer to that one. Nate, I don't know if you have an opinion on this. Any thoughts, or if a repeal of the SALT tax is in play?
Yeah, a repeal on the SALT tax would be in play because that irked the Democrats, because the highest tax states, whether it be New York, California, Minnesota, got hurt the most by limiting how much we can deduct for property taxes and state income taxes to $10,000, whether you're single or married. some of us have much higher tax bills and we'd love to deduct those dollars. And so if the Democrats gain control, you could expect that they'd be working to get that particular change undone sooner.
Sure, that makes sense. You know, the next couple questions are, I think, probably capture a lot of our clients' thoughts around this and touch on a few things that we're thinking about all the time. But one is just around, you know, is this, should I be taking steps immediately, or should I be sort of monitoring and preparing for these potential changes? You know, I'll let you give your thoughts, Nathan. Mine are really around, you know, these potential changes are not going to be, in my opinion, 2020 tax return issues, or probably even 2021 tax return affecting your 2021 return. Likely it would, you know, take some time for them to be implemented, and maybe, you know, making a best guess, maybe that's 2022. What do you think on that front, Nate?
Yeah, so 2020 is safe. 2021 could be at risk because if the Senate would become majority controlled Democratic Congress, they can pass laws at any time throughout the year and backdate them, where any decisions you made would be taxed at whatever the rates were by the end of the year. And so 2020 is definitely safe. 2021, again, if you flipped a quarter twice and flipped it up heads, that's a 25% probability that the Democrats would win both seats for the Senate. So when you do anything with your money, you want to look at the probabilities and be moderate in your approach to planning going forward. You don't want to do anything rash or extreme as you prepare. So what we'd recommend is to average in to your strategies. And as we gain more clarity and get more certainty towards that finish line, then you can be more aggressive. And if you need to do something big, definitely talk with us first.
Absolutely. Here's another one. Somebody who's interested in this concept of Roth conversions that we spoke about. So in other words, accelerating income, paying tax at what we think would be a lower rate, to prevent that from being taxed later on. But this person talked about the fact that they've always held off on doing this just based on the assumption that their tax rate will be lower in the future, and just asking for our opinions on how to think through this. How would you address that, Nathan?
Yeah, so it's complex. We had to run a number of scenarios through some pretty sophisticated software to test our thesis, but Roth conversions pay off in a bigger way than just a part of, am I paying less in taxes today on the same money than I pay on that same money tomorrow? Because your distributions from retirement accounts impact other types of income. So your Social Security check can be tax-free or almost completely taxable based off of how much income comes from your IRAs. Your Medicare premiums can be quite inexpensive versus exponentially more expensive based off of your income that comes largely from your IRAs. Your gains and dividends from your portfolio can be completely tax-free federally, or what we saw in that chart, taxed at 40% federally if you have large IRA distributions. And so the sum of the parts in many scenarios allows for folks to save tens of thousands, hundreds of thousands, or millions of dollars over their lifetime by vaccinating their wealth up front with Roth conversions. Especially if you do that in a downturn in the markets, you actually cut your tax rate in half and your long-term tax bill as well.
Absolutely, yeah. Bottom line, every situation is unique, and it certainly warrants a thoughtful and closer look. You know, just a couple of final points as we wrap up today. Nathan, last one for you here. Any movement by Congress, you think, in the lame duck session to take action on the tax treatment of the PPP loan forgiveness income? Do you have any insight there?
Yeah, as far as whether it's tax deductible or not. Uh,
Right.
the guidance that we've received so far states that it is tax deductible, like any other business expense. And that's been worked through Congress and the IRS throughout this whole pandemic. And so to expect that to change here in the next 2 months might be asking a lot. However, going forward, if there was additional stimulus, the new Congress, depending on how they're made up, could impact that. But I would lean towards status quo versus any big changes.
Got it. Got it. Thank you. Well, maybe if you want to show our last slide, I'll use that to speak to the last couple points. We had one question from a business owner talking about the potentially a reduction in the state tax lifetime exemption amount, and how you might think about that in terms of removing the value of a business from an estate in an efficient way. And I think that's probably a too detailed question to address fully here. I would say there's some pretty unique opportunities right now on that front with interest rates where they're at, and using something called private financing within an irrevocable trust. So if that's of interest, certainly let's have a further discussion there. It really can be powerful. But then finally, there's kind of one final question, and I show this slide to illustrate our financial planning process. So we partner with our clients to comprehensively and strategically manage their wealth, really by identifying their goals, creating a plan, and helping them implement that strategy in a way that works for them. And the question was around kind of what tools do we use? Our formal process we've named Wealth Nav. That kind of is the overarching branding of our process, if you will, but really it's all encompassing. So in terms of the tools, we have tax planning software, analysis of someone's tax situation. We comprehensively look at an individual's portfolio and investments and where things are located. Are they in retirement accounts? If so, what kind? Taxable accounts and whatnot, and really try to pull all that together into one spot. And so this would just be a reminder for any of you, if you're curious or if you'd like to know more, you can reach Nathan or I. You can email directly to learnmore@boullaygroup.com. Again, it's learnmore@boullaygroup.com. We thank you for your time today, and appreciate the interaction, and reach out if we can be of any assistance going forward. Thank you.